Hi, I'm Keith McCullough, and welcome to another edition of Real Conversations, where it's my pleasure and privilege to welcome Mr. David Stockman, who really needs no introduction, but he was indeed the director of the OMB, or the Office of Management and Budget, under President Ronald Reagan. He's got a lot to say, and I'm looking forward to sharing our conversation. Hey, David, good to have you back on Hedgeye TV. Thanks for making the time.
Great to be with you. Got a lot to talk about today.
Yeah, I think we might agree on a couple of things too, so we might have to be careful here.
Okay, all right.
Well, first I wanted to congratulate you on your book. I think it's the title by definition might mislead people, but I wanted to get into how you thought about it, and of course your new book, Trumped: A Nation on the Brink of Ruin and How to Bring It Back. How did you think about writing that? Of all the things, David, that you could write about, obviously there are many, but could you just kind of give me the first part of that?
Sure. You know, in my daily blog called Contra Corner, I'm focused on the nation on the brink of ruin part. And so the book is essentially an elaboration of those themes about how we failed abroad with war after war that has been pointless, how the domestic economy has taken on this massive bloat of debt, both public and private, that's changed the whole leverage ratio of the economy. It used to be 1.5 times, it's 3.5 times now. We have 64 trillion of debt, as a lot of people know. And third, how our whole financial system has broken down as a result of what I call the rogue regime of the Federal Reserve. It's resulted in bubble finance, the destruction of price discovery on Wall Street, and the massive dominance in the system of central bank daily intervention. So I take all of those themes, war, debt, and bubble finance, and develop them, substantially, but point out that it's created a bifurcated reality in America that's very dangerous. The bicoastal elites are doing just fine because they live off Wall Street or Silicon Valley or some of the hotbeds of venture capital, or the imperial city itself with all of its spending for both the warfare state and the welfare state. But on the other hand, in between, and that's the cover of my book, you have this vast zone between the coast that I call flyover America. Much of it is hurting economically like never before. I lay out some of the data on that, but I think there are 2 points worth mentioning at the beginning. One is that if you use a valid measure of the cost of living faced on Main Street, I don't mean a PCE deflator, less food and energy and other things, that the Fed obsesses about, but real cost of living with the 4 horsemen of inflation, food, energy, shelter, and medical. And you deflate the median household income by that, flyover CPI as I call it, real median income is down nearly 20% since the turn of the century. Nothing like this ever before. That's a shrinkage in the standard of living, not just a small lapse or a temporary setback. This is huge. We haven't seen this in 100 years since the Industrial Revolution began. The other factor or data point I indicate in the book is real net worth. If you go back to when Greenspan took over the Fed in 1987, the real net worth of the bottom 90% is not increased by a dime. It's flat over almost 30 years. The real net worth of the top 1% is up by 300%. In real terms, the Fortune or the Forbes 400 by 1,000. Now, I'm not trying to do some Krugman, left-wing rant about maldistribution of income or bad tax cuts and all that. I'm saying this isn't the outcome of a healthy, natural market capitalism, because in a healthy capitalism, everybody marches higher together. That's the whole nature of capitalism and why it's such a wonderful system. When you get this bifurcated outcome, massive economic success for a tiny fraction of the population and setback for most of it, the lower 90% or lower 60%, then you have something else. You have what I call a mutant form of casino capitalism. I blame the Fed for it, And I think that's kind of the heart of where I go in the book.
There's one slide that I'll get to show you if you haven't seen it already. It's interesting, if you try to find the causal factor in all this, I wonder if this is just it, David, or not, if you agree. But if you look at total financial assets and who owns them, 84.5% of total U.S. financial assets, i.e. the markets, are owned by the top 10% of the people. So isn't that the point, is that people that have the money want to perpetuate the asset inflation and the rest of the people get the cost of living inflation in exchange for that?
Yeah, but it's even worse, and you've hit the nail on the head in terms of my book. I have a chapter called The Warren Buffett Economy.
Really?
And it's a metaphor, but what I'm trying to demonstrate is that once we went down the road of what I call Keynesian central banking with Greenspan, we had a huge financialization of the economy. So what I do in this chart is I take the sum of debt outstanding plus the market value of equity relative to GDP. Let's call it the financial ratio of the economy. Back in 1987, there was about 9 trillion of debt and market cap outstanding. The GDP was half that. The ratio was 2 to 1. Today, this is a startling number, it's 93 trillion. The value of debt, which is 64 trillion, plus the market value of equity is 93 trillion. We know the GDP is 18. We're at 5.5 times. Now, that huge increase in what I think you could call the capitalization rate for the national economy is not warranted by the performance of the national economy. In other words, as everyone knows, productivity has been declining. Investment in real terms after depreciation has gone negative. GDP growth is at, on a trend basis, less than half its historic level. So you would say that if a entity, whether it's a business corporation or a whole economy, is suffering from a diminishing performance and growth rate, you would expect the cap rate to go down, not up. But our cap rate has gone from 2 times to 5.5 times.
Well, isn't that, I mean, if you look at it, for what it's worth, and you take the demographic lens, of course, there are many different angles I want to go through on this, but if we isolate that lens, which is something, David, that you and I are not going to change, it's just time and space, and we look at the population growth rate of the 35 to 54-year-old spending bucket, i.e. the boomers, and where they've moved, and now they're negative. So you've basically gone from the 90s, where they were the biggest generation and the biggest spenders, to having a negative population growth rate. So that, is it not wrong that Greenspan handing over to Bernanke had to try to replace organic growth or organic demand and high ROI investments with leverage?
Well, I think that's what he tried to do. I think it was a catastrophic error, because what it actually ended up doing was punishing that aging baby boom population that needed to save, forced them into either risky investments that they got clobbered on twice, the dot-com bubble, the housing and 2008 crash, and the next one coming if they'd gone in for the third dip, or they have saved so little and they're getting so little return on a liquid, safe, short-term investment, bank account, for example, that they're going to end up retired with nothing to live on. This is getting to be a huge thing, because they'll be totally dependent on Social Security. I have a whole section in the book where I show Social Security will be insolvent from an accounting point of view. It already is from a cash point of view, but from an accounting point of view by 2026. So imagine the perfect storm. The baby boom will hit full force retirement by the mid 2020s. Social Security will suddenly be absolutely bankrupt from an accounting point of view, which results in an automatic 33% cut in benefits. It will be a crisis like we've never seen before, and it was one that was generated way back in the 90s and early 2000s when they went this bubble finance route. It did not help the economy, and it dramatically punished most of the baby boom population. Now you have the 1% or the 15% that you cite that own most of the financial assets, but the question is, those financial assets are tremendously overvalued. We know we're dealing with the mother of all bond bubbles in the world when we got 13 trillion of sovereign debt trading at sub-zero yields. I mean, the very idea when we were learning about things a few decades ago, that the governments could be paid to borrow money. When anyone who's been trained in sound finance know that governments are dangerous borrowers and should be discouraged, not encouraged. Well, anyway, it's a measure of how far we've gone. The stock markets of the world are enormously overvalued. As we sit here today, they're trying to rally the thing again. But earnings came in on a GAAP basis, the only honest basis of earnings, at $87 a share on an LTM basis for the quarter just ended. So we're trading at 25 times trailing on earnings that have actually declined, as you know, from the peak in September 2014 by 19%. By 19%. In other words, the LTM in September, and that's kind of when the economy peaked, the GDP peaked, the real data that you look at, because anything after that, you can look at, CapEx orders, you can look at exports, you can look at transportation statistics, freight statistics, and so forth. It all peaked then, is coming down, industrial production as well. So if you're down 19% from the peak earnings, why are you trading in the nosebleed section of history? And 25 times trailing is the nosebleed section of history. I have a little section in the book where I said, this seems a little suspicious. It feels like I've been here before, okay?
A little.
And so I go back to 2007, the middle of 2007, and I look at the GAAP earnings that peaked right about then, and it was trading at that point at 19 and a half times trailing GAAP. And then, of course, we know a year later, the market was down 55%. So here we are, the third time around, with an even more extreme valuation on the earnings of the corporate sector in an economy that is about due for a recession, facing enormous headwinds. After 87 months of expansion, this cycle is long in the tooth. And we have a mentality, particularly in the financial markets, that somehow assume that the business cycle has been abolished, that we're going to have full employment forever, world without end. And that is nuts. You should not be capitalizing earnings at the end of a business cycle at a peak rate. Does it make sense?
And and this time, as opposed to just to your point, equities, it's debt. We have the largest enterprise value in world history associated with this, with the greatest surge in corporate credit issued of all time. And it's almost like, David, I'll go meeting to meeting, and this is not a joke at this point, because this is what's going into people's pension funds. But if Wall Street issues any piece of paper that has a yield, that's going to have the level of demand that maybe fogdog.com had in the 1990s.
Yes.
It's a bubble of behavior, really. And I wonder what you think about that. How complicit Wall Street is in not only its compensation mechanism, obviously, but how it behaves, like how they talk about this time is different and why you should pay an all-time peak multiple at this stage of the cycle.
Well, I think it goes back to the central bank policy, though, because it's a matter of incentives. If you basically drive the yield on high performance credits or sovereign debt to the zero bound or close, because after all, 10 years, a while back, a few weeks back, was trading at 1.34, as you remember. You are flushing the bond managers of the world, the money managers of the world, into a stampede for yield. And so whether they think it's sensible or not, they're not going to be paid. They're going to lose their investors if they don't beat at least the cash yield. So they buy all this stuff. That's how we got something like 350 billion of high yield debt in the shale exploration and development sector. That is a highly risky business that's driven by the world's most radically unstable commodity. Wouldn't we agree? Oil, goes to 150 and then it goes to 25 and then it's back up to 100, then it's back down to 30. In that industry, you would never want to basically burden the business operation, the balance sheet, with massive amounts of high yield debt, nor would you want to buy it. But they were so desperate for yield, Wall Street peddled all of this all the junk debt and various kinds of preferreds. And so we had this enormous drilling boom, partly based on real technology and resources that were there, but mainly on subsidized debt, ultra cheap, uneconomic debt that lured, the industry into the shale patch.
You know, David, there are very few people that will agree with you as much as I do on the causal factor that is the Federal Reserve making us behave this way on Wall Street. I also wonder what you think, just because you gave this example specifically using shale investments. I mean, we have prominent, I would say prominent, not fringe investors, Lee Cooperman to name names, who made not only his funds investments, but his personal investments, Lynn Energy, Atlas Energy, which has currently got him in a little bit of hot water. But I wonder how much, and in this case, as you know, Leon Cooperman used to be the head of research for one of the best firms
Sure.
on Wall Street, Goldman Sachs. How complicit is the buy side in perpetuating the Fed's behavior?
Yeah, something that's kind of a symbiotic relationship. I think you've reached the point now where the Fed measures its success and its kind of superintendence of the economy by the stock averages. And so if the stock averages keep going up, all must be well, and it can keep the game going. On the other hand, it fears a hissy fit on Wall Street. It fears any kind of negative sentiment among the bond managers. And so it keeps doing, among the stock managers, among the gamblers, as I call them, it keeps doing what they demand. And otherwise, how could you explain 94 months of zero interest rates? That is an ultra emergency rate. You probably never should have had it in the first place. But if the economy hasn't recovered after 94 months, when they say, Fisher, for instance, Stanley Fisher says we're almost at full employment. Well, if you're a tad from full employment, or if you're almost at the 2% inflation target, which is another whole issue, we shouldn't even be doing that. But if you believe in that and you're almost there, and of course they've admitted that, because if you look at the CPI less food and inflation and take out the temporary oil thing, you're in the high, you're at 2.3 in the last 12 months. So if you're almost at your goals, how could you be flat on the zero bound in an emergency rate? They are lost. As I say, they have descended so far down the Keynesian rabbit hole that they can't see daylight or reality anymore, because they're focused on objectives that really aren't in the Humphrey-Hawkins Act. They've just made that up. But they're focused on matters that monetary policy can't deal with. They're constantly talking about slack. I submit whatever slack we have in the labor market, and it's massive, is structural.
Getting back to your point on the Fed, I thought for those people who haven't read it, David, you just wrote a great piece that's called "The Fed's Monetary Politburo is Finally Catching Some Flack." So for a long time, David, you, Jim Rickards, I think to a degree, I get my shots in. We've been very critical of the Federal Reserve, but it hasn't really found a broader political platform where somebody in Michigan might know who the hell Janet Yellen is.
Right.
That worm seems to be turning. I guess Mr. Trump threw it out there and Hillary didn't bite, but it looks like some congressmen have.
Yeah, and there's now a lot of. It is in some ways a very narrow partisan thing. They were having a big set to on Capitol Hill this week, because one of the Fed governors, Lyle Brainerd, has been in-your-face supporter of Hillary, contributed to her campaign, is busy lobbying for the Secretary of Treasury job, even as she's voting on delicate decisions about monetary policy in the run-up to the election. So it is kind of a awkward or crude way to get to the issue, but it's putting the spotlight on the Fed. And what I've tried to do now in these articles to say the Fed is enormously political, but not just in a narrow partisan sense. What they're doing is substituting political governance of the financial system for market-based determination of asset prices and the cost of money. And that's ultimately political. You're substituting the judgment of tens of millions of investors and traders and speculators and everybody else with the ideological views of 12 people who happen to be sitting on the FOMC at any moment in time. It is a bad deal.
It's brutal. It's awful.
If,
You said in this pointed commentary, this can only be accomplished by an elite Politburo and one that is accountable only to itself and its esoteric economic models. The accountability thing, David, that's something I wanted to really dig in on here, because I want the Americans that are watching this and people more broadly to understand that the Federal Reserve is not an elected body.
Right.
So we have an unelected body that is being championed and cajoled by the bankers who are trying to get paid through asset inflation and fees, and it feeds on itself. How do you break the back of this very basic thing? If 95 or even 80% of Americans, 60% of Americans knew that the Federal Reserve was an unelected body, do you think that would change?
Well, I think, you're going right to the heart of the matter, which is the myth of Fed independence. That is a convenient myth. It's based on what we were citing before, the belief that monetary policy is such an arcane, esoteric, and demanding art that the people of America should have no voice, Congress should have no voice, and unelected Politburo should, in its wisdom, run the financial system. And that they have perpetuated that myth now for the last 20 or 30 years. I call it a cover story. And what I like about what Trump is doing and the hot flashes that are now going on about the Fed politicking is that it opens up the debate. Why should we have political governance of the financial markets when the auction process and price discovery in the free market would be far more efficient, far more stable, far more productive? Therefore, the big ig is, do we have politically set interest rates or do we have market determined financial asset prices? That's the big issue that's being opened up, but you can't really open that debate until you pin the tail on the donkey and say there's no such thing as independence of the Fed.
Right.
It's an inherently political institution. It's saying, as I said in my article, it's saying we like debtors, not savers. Okay, we like short-run speculators, not long-run business builders. They're choosing sides, and that is something the market would never do. The market is ruthlessly efficient, and we need to bring back that capability.
We got a guy here who is also the recipient of, obviously, the real estate bubble and this entire asset reflation. Does he actually have it in him to understand or even go inward or shoot against himself and take this right to the mat with Hillary and actually make this a real topic that she can't get away from?
Well, you would think not, because you are totally correct. The biggest beneficiary of this 30-year financial asset bubble that we've been talking about is the real estate developer industry. Trump was front and center in that, along with a lot of other New York and based developers. And he, therefore, was the biggest beneficiary of ultra cheap interest rates over the last 30 years. On the other hand, now that he's running, seems to have a mission that has overtaken his motivation, and has seen that the Fed is really doing everything it can to hurt him, and has now perceived that it is partisan and political. Maybe it's kind of the scales are coming off his eyes. He said in that debate something that no candidate has said in the last 30 years, that this is totally artificial, that the market is going to crash, that we have a big, fat, ugly bubble that isn't sustainable.
I wonder if he has it in him to take her to the wood on this. And again, if he doesn't, the reality is that the debate will rage on. And I wonder on this next part, and I hear this a lot. I don't know if you've heard this or not, David, but this grand fiscal spending plan that's going to help build the bridge from A to B. In fact, one investor told me in California this week that this was going to be a fiscal extravaganza.
Yeah.
And I don't doubt it. I mean, if Hillary wins, a lot of us have been talking about Larry Summers lobbying hard to become what a lot of people may not know, but the head of the Federal Reserve, where he can then get Lyle Brainerd as the new Treasury Secretary to
Yeah, and they'll do a 1-2, and this is really what Bernanke's talking about with his helicopter money. The whole theory is that the fiscal authorities will deliberately create a massive target level of debt, and the
yeah.
Fed will buy it in dollar for dollar, and we'll all march off into prosperity.
Yeah, that's what they like. Literally, he's saying that he wants to issue, from what I understand, and I don't have bad contacts, that he wants to issue 50-year U.S. Treasury paper at a targeted rate, like the Japanese are doing.
Yeah, well, I'll tell you what. I think, though, that that's a lot of wishful thinking on the part of investors. I've heard the same theory that if we get a big infrastructure going, infrastructure process going, then that's going to spur CapEx. The reason the economy has been lagging and languid is that CapEx has gone flat or negative, and so it's all going to work out. What they're failing to note is that the minute the economy tips over, which I think it will, before they can do any of this, it takes a year and a half to get any money out the door in Washington. Before they can do any of this, we'll be in recession. The budget projections will go to the $1 trillion a year red ink level. The system will be paralyzed because there's still half of the House that's scared to death of a 20 trillion debt that's going to be projected to grow even more rapidly than it has been in the last few years. So I think we're going to have paralysis. I think if Trump's elected, there'll be a food fight. There will be no big infrastructure program. The economy will go into recession. The budget deficit projections will go into the trillions, and the chickens will come home to roost. If Hillary's elected and tries this, everything will be killed in the House of Representatives. It will be Yes, it will be a killing field for this maneuver if they put Brainerd in the Treasury job and they bring Larry Summers. Larry Summers is one of the greatest, fortunately, one of the greatest jackasses in the Western world. And put him at the Fed, and you will open up a debate about the politicization of the Fed like never before. If you think like we do, and want to get the Fed out of the financial markets and shrink it back to its original tiny mission, the greatest thing that could happen is to get Larry Summers as chairman of the Fed. It would be a nasty, wide open political debate after that, and maybe we would open up the debate about monetary policy.
Well, I mean, at the end of the day, the reality is that if Hillary wins, that I guess that jackass scenario that you called it is a high probability jackass scenario. I mean, it's not like, you watch this guy, he's in there every day, really being critical of the Fed because he of course believes that he was born to this earth to save us himself, and that he could do it better. It's not unlike Trump, who doesn't believe in government spending unless he's the one who's running government spending. So don't we have, is that the point? If Trump wins, we have Trump, and if Clinton wins, we could have Summers.
Yeah, no, we have J.M. Keynes's Vicar on Earth, Vicar on Earth, and yeah, you're right. It would be a terrible thing, but you have to remember, it would be so partisan that everything that Hillary was trying to do would die in the House. They would blame the recession on the last 8 years of Obama. Remember, it's being set up, and I think this is the important last point to get across here. The recession will overcome the economy next year before either a Trump or a Clinton administration can get traction. The Trump administration, and I know this well from my experience because I was there in 1981, when Reagan was unexpectedly elected. For the next 3 years, we blamed the mess in the economy, the worst recession we'd had since the war, on Jimmy Carter. Okay, and we got away with it, and we sort of did some of the right things that needed to be done.
Thanks for, again, I call it American patriotism. Thanks for being so brave with your views and being so truthful.
Thank you. Good to be with you again, Keith.
Thanks.